So the first step in the no chase swing method is marking high probability zones on the higher time frame. This is going to be the foundation of every single trade that we take. Now, a zone only matters if it comes from a clear cause and effect, and that means one of two things. The first is that the zone created a liquidity sweep. It can look something like this, where we're trading basically in a range, take out lows, reverse direction. So that is a manipulation of lows, and this is going to be the liquidity sweep. So it can look something like this, where we're trading in a range, we take out the low, and then we reverse direction, and then continue in the upward direction. That's going to be a manipulation of downside liquidity. Or it can look like something like this, where we're trading lower lows, lower highs, lower lows, lower highs, and then we trade a little bit lower, and then we reverse direction. So that's going to be a manipulation of the previous lower low. So the second thing is that the zone caused a move that led to a break of structure, or BOS. So on this example right here, we have two structures. We have a smaller distribution followed by a larger accumulation right here. Now, I know we haven't covered distributions and accumulations yet, but just for this example's sake, this is kind of what it looks like. So in this example, we have two microstructures. We have a distribution and an accumulation. So the accumulation we can see is responsible for breaking structure to the upside of this previous distribution. So this accumulation caused the break of this distribution. So in this bottom example, if the price only came up to here, but it failed to take out this high, I'm no longer interested in taking any trade from this zone right here. So here's my exact process for finding zones. For step one, I'm going to go to the higher time frame, and generally I like to use the daily or the weekly chart. Step two is I'm going to look for where price made a clear break of structure. So if we go back to the previous example, I'm going to look where price took out previous highs, not where price came close but failed to break a structure. So step three is I'm going to trace back to the origin of that impulsive move. That is going to be our zone. So now let's go to an example. So for the first example, where the zone created liquidity sweep, we can see that we had liquidity sweep, break a structure to the upside. Now, typically the zone that's responsible for breaking structure to the upside is usually in a discounted area. So that means it's going to be at the lower half of this sell to buy movement. And if we look over here, it's very similar. It's going to be at this premium, and it's going to be at the sell to buy movement. And if we look at the case below, we can have technically two potential structures right here. We have technically a liquidity sweep right here, and then a break of structure to the upside. So this could be our zone. And technically, this could also be our zone because this is the last unmitigated zone that caused the break of structure to the upside. So step four is we make sure that we draw the zones cleanly. I don't make every little swing, only zones that create the break of structure. So now let me show you an actual example. So this is going to be a case where we have a liquidity sweep followed by a break of structure. So you can see that liquidity is clearly marked on the bottom. So this is a typical retail move where people trade wedges and other diagonal trend lines. So a lot of people, when price approaches the bottom of this trend line, they're going to buy. And as a retail buyer, right, if price goes below, you're going to take a stop and get stopped out. And in this case, that's exactly what happened. So price briefly dipped below and it swung back, reversed, and it took out this previous high right here. So this is going to be our liquidity sweep. Now, if we look at the chart closely, you can see that this area right here, where we have a sell to buy candle, that's our manipulation, this is going to be the origin of our zone because this is what caused the actual break of structure to the upside. Okay, so here's an example of a zone that is not valid. Right here, we have an impulsive move to the upside, and this looks like a pretty strong impulsive move. Now, some people would mark this as a valid zone, but for me, it's not valid because it doesn't have proof of strength. If it was so strong, it should have been able to take out previous highs, right? We came very, very close to it, but why couldn't we just break past a little bit more? That would have shown and confirmed strength. And look what happens if you would have taken this as a zone. You would have simply got liquidated and stopped out of your position. So the goal is clear. We're only finding clean charts with zones that matter. That way, when price comes back, you know it's returning to a level that already moved the market with strength. So now I'm just going to go through a few examples of zones that are valid and zones that are not valid. So here's an example of a valid zone. We have our classic liquidity sweep. We have our break of structure to the upside. And if we look back at the chart, we can see that we have this large area of inefficient price action. And this was the cause that broke structure to the upside. So this is going to be my higher time frame zone. Okay, so here is an example of a zone that's not valid. So we have an impulsive move to the upside right here, right? And we even have something that can maybe be considered a liquidity sweep of some sort. But what we fail here is we do not have a break of structure to the upside. This zone has not confirmed any strength. It just simply came to this area of imbalance and sold back down. If it had strength for real, it should have been able to take out this high and then retrace to be mitigated again. So this is an example of a zone that's not valid.